Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I'm joined with Jason Balara. Jason, welcome to the podcast.
Thank you so much, Whitney. Thank you for having me. I'm excited.
Excellent. Well, Jason, before we dive into the details of Cedarview Townhomes, 70 units in Jonesboro, Georgia, right outside of Atlanta, tell us a little bit about yourself and how you got into multifamily and where you're at today.
Yeah, sure. I am a lot of people that knew me before real estate. I'm actually a veterinary surgeon. That's kind of my day job, I guess. But I have always worked since I was basically a teenager, worked in construction, did a lot on the residential side. It was about 3 years ago that I started to look into investing more seriously as whether it's a career, I don't know. I guess it started as a side hustle, but it certainly gets busy fast. And so, yeah, about 3 years ago, I started, I did a mentorship. That was kind of my first step. And it took me about a year to get the first deal under contract, kind of going through the process of meeting brokers and all the stuff that they tell you to do in the mentorships. And then since then have been a part of the GP team on 4 multifamily deals and a self-storage joint venture. So ultimately, and I have actually done some passive investing as well along the way. So just trying to, I guess, as a surgeon, I know the only way I can make money is being in the OR. And so in a way, trying to get to a more passive focus, but I also like being a part of the deal. So some of it is going to remain active for sure.
Well, let's dive into the details of Cedarview Townhomes, 70 units in I'm going to keep messing that up. Jonesboro, Georgia. Sure. All right, let's talk about how you found the deal. Let's back up the timeline because you closed it in July 2022. So, right,
Correct.
let's back up the timeline a little bit. And how did you find the deal?
Yeah, so really broker relations. The first couple of deals I closed in the Atlanta MSA were in December of 2021. And so, as everybody says, once you close a deal, now you've sort of shown them that you can, and suddenly now the brokers will talk to you and they'll spend time. And so through the process of those other deals I had built I have good broker relations in Atlanta. And so, I was going out to, I go to Atlanta at least once a month, and I was going out to check in on our properties that we already had, but also I would tour properties. And there was one, I want to say it was in March of that year, of last year, 2022, that I went out and in 2 days, I toured 12 different properties. I live in Los Angeles, so I try to be away from family as little as possible. And so I do try to pack as much in while I'm there. But that was kind of the start of it because Cedarview Townhomes was one of those 12. So you can fairly quickly weed out a lot of them once you kind of look at the numbers, surface numbers, look at the location, that kind of thing. But yeah, Cedarview Townhomes kind of rose to the top. And so that was of those 12, that was the one that we pursued, from that point.
So, okay, so you're pursuing this property, and were you the only, partners pursuing this property, or were there other groups?
I have 2 other partners on the GP team.
Okay, were there other groups that you were competing with offers or not? Yes,
it was a marketed deal. I don't know. It went pretty smoothly in terms of getting under contract. So it wasn't like we got in this crazy bidding war, but I think it was, there were definitely other offers on the table.
Awesome. Well, let's talk about how you won the deal. How did you structure your offer, and what do you think helped you seal the deal on this one?
I think, and it's funny because, last spring was a very, very different market than it is right now. And at the time, you almost couldn't get a deal under contract if you didn't do hard money day one on the earnest deposit. Now, what we would do with that, and what it creates a bit of safety. We would always have a pre-access period before that money ever got wired over. So in theory, you do have a little bit of time to get there and at least do your physical due diligence and do, like a lease audit and stuff like that, make sure there's nothing crazy. But so we had hard money from day one, at least after the pre-access period. We had fairly, I guess, we had confidence of the brokers in terms of our ability to close. We had just closed 2 other deals in that location. We had a good property management set up in Atlanta. So we kind of had the right team in place, and the brokers knew that. So I think that it was a surety of close. I think we didn't try to, sort of undercut price or anything like that. And again, it's a very different market than it is now. And so you probably, as a buyer at that point, you were making a lot more concessions than you might today. But I don't think we had to, sort of give up anything crazy. We paid, I think we got it at a good basis even still. And, I think probably a big part of it is just the hard money right from the beginning.
Awesome. Okay. So let's talk specifics. How long was your pre-access period?
We had 10 days.
10 days. Okay. And then how long, when you finally went under the purchase sale agreement signed, like how long did you have for due diligence and, closing? Did you have any extensions?
Yep. We had 30 days of due diligence, and then we had 30 days to, put financing in place from there. And we actually ended up we had 2 15-day extensions to tack on there, which we ended up using. It was right. So we closed this July 12th, which was, I believe, 2 interest rate hikes into the process. And so it was kind of one of those things where we saw it happening, but it hadn't really impacted our underwriting at that point. We had underwritten for a higher interest rate anyway. And so it wasn't anything that I think at that point, nobody knew really what was going to happen from there. But I think we were probably up the first 2, maybe 75 bips from what it was when we first went under contract. So the extension had a little bit to do with that. There was also a question through due diligence about a fire inspection that the sellers had performed and had to kind of come up with the paperwork. So we got the extensions for small things, like we could have closed, but we just wanted to, cross the T's, dot the I's.
Mm-hmm. And just for perspective, we're recording this in March 2023, closed in July 2022. You said during that time, we'd only seen 2 interest rate hikes. Guys, today, as of March, we've seen, I think, a total of 9. Yeah. So yeah, we were at the very beginning.
One yesterday.
And one yesterday. We were very beginning of a very long path here. Okay, so now if you exercise those extensions, did you have to put additional earnest money down to exercise it?
Yeah, we
did. And was it hard?
Yep. Yeah, okay. It was. I don't know if you want specifics on that. I can tell you.
Yeah, tell us. Yeah.
So our initial deposit was $150,000, and then we had to put $25,000 for each extension. So
and how did you guys fund that? Was that out of your own funds? Did you precede that with the investor rate? Like, how did you do
the
that?
Initial deposit in the first extension was my funds, and then by the time we got to the second deposit or second extension, we had investor funds there. So we used that, but I guess if something had fallen apart, certainly that the investor would have, they would have gotten their money back on that. But it was, at that point, we were very confident that we were closing.
Okay. So what did you see about this deal? What was your overarching business plan? What was your vision when you saw this deal?
Yeah, it's a great question, and actually relevant to this deal because something's changed as far as that goes. So we kind of went into the property. It's 70 units, as the name implies. It's townhomes, so they're 2 and 3 bedroom, multi-story properties. Really, really nice for families. Right. So they tend to be the type of, for people listening, they tend to be the type of product where families are going to move in. They're likely going to stay a long time. So the business plan was we were going to go in and renovate these to quite a high level and be able to push rents from there and have, this really nice product. We had even toyed with the idea. It's not far from a very large medical center in it's south, south of Atlanta. We had toyed with the idea of even converting some of the units to like nursing rentals, midterm type rentals, and furnishing them. But so that was our initial plan. As I alluded to, some of that changed for a couple of different reasons. I don't know if you want me to go right into that, but one of the problems, and I'm sure this is in other markets too, but one of the problems in Atlanta is in and around Atlanta, the county, there's challenges with delinquency. So everybody knows we went through COVID. There was an eviction moratorium. Basically, in a nutshell, what is going on now is it's hard to evict people. Now all the assistance money sort of went away. And so it's hard to evict people in a timely manner, I think, basically because the municipalities do not have the infrastructure to handle the backlog of what built up during COVID and essentially the subsequent years since the eviction moratorium was lifted. So there's this backlog where it previously took maybe 30 days to get an eviction processed, and now it's anywhere from like 6 to 12 months, depending on what county you're in. So what we were faced with is one thing, the seller did not fully disclose to us how much delinquency there actually was at the property. And so when we took over, we realized it was a bit worse than we had anticipated, as well as there was more vacancy than they had disclosed prior to closure. So we had to pivot. We changed our business plan initially to not such, we essentially made very specific renovation scopes for each unit as it became available. So some of them, one of the nice things about buying this property is about half of the units had already been renovated to a fairly nice level, and we were kind of just going to top it off, like add granite countertops, washer dryer connections, that sort of thing. So what we realized is, okay, let's take what we have right now and very specifically address it and manage cash flow in the beginning. And then we can always go back later, and as we get everything stabilized, now take each of those units that come available, and if we want to put them to a high level, we can test some of those out. So, one of the, obviously inflation has impacted pricing on a lot of things, but also it's elevated rents. And so even with a lower scope on our renovations, we're achieving above rent but rental rates above what we proformed. So you can balance, luckily, you can balance some of those, hardships with the fact that rents are still quite a bit higher, and you just have to be really, really specific about where the money goes.
Well, I have a couple of follow-up questions here. One, but then I want to get back into like the due diligence, because you mentioned fire. I'm sure there's there's a story here. Yep. Okay. So I agree, right? Like, operators, have been blessed with, especially in the past years, seeing that increase in rents. I have two questions for you. One, do you foresee that trend going, or do you see rents flatlining? Because that would certainly impact value and impact the business plan. And then two, if your cap rate expands, that kind of eats into that NOI growth and the future value of the asset. So how are you accounting for that? Yeah,
so the rent growth, I think it will continue to go up, and it's going to be very market specific. I don't think it's going to go up at the rate it's been going up. You have, and I don't know if other people see this, but I actually feel like if you have a somewhat unique product, the demand might be higher. So for example, this property is all townhomes. We have had really no problem leasing them. That has not been an issue. We've had these other issues, as I mentioned, but really no problem finding people that want to come and rent them. So that's been good. I think, like I said, and if as you place families in these units, they're likely to stay longer. So you're not going to have that sort of constant turnover. And so we are still trying to provide a very nice quality. It's just not like, top of the market in terms of renovation. So I think we'll still see rent growth. I don't think it's going to be, it was in the teens annually before, and we're probably still going to be between 3 and 5%, 3 to 5%, I would guess, annual rent growth. which is still in line or better than what historically it has been. I also think Atlanta specifically, another reason I like the market is just that in terms of the country overall, it's still very affordable rental rates. So even now with all the growth that there's been, it's still below the annual average in rental rates. So we still have some room to grow there. As far as your second question, I mean, the cap rate expansion is certainly something that we have to take into account, and we underwrite it already going into it as expanding. So we didn't underwrite it as if our cap rates were going to get even lower. So we've taken some of that into account. Now, a lot of this is just going to have to come down to timing, right? So like if you had to sell right now, it's not a great time to have to sell. Like I don't think that's a mystery to anybody, but in a year, 2 years, 5 years, whatever it is, I mean, that's one of the beauties of real estate is we can kind of hold these and then look at where we are in the market cycle and figure out when's the best time to either refinance or sell or whatever the case may be. So do I like it? The cap rate's expanding? No, like that's not good for us. But if the rates come back down to, maybe they won't go as low as they were, but if they come back down to, sort of somewhere in the middle, we'll still be fine in terms of what the cap rates are going to be at. That answers the question exactly, but that's kind of my take on it.
It's kind of you didn't say it, but it kind of goes back to that answer in real estate. Like, yeah, you pose a question, there's so many factors, and you go like, well, it depends, right? Right. What exact scenario are we looking at here? Like, at what moment in time, right? So thank you for your insight on that. So let's bring it back to the due diligence piece, right? So you now have this preview. You were able to go on the property. Were you walking all the units? Were there any surprises there? You mentioned the word fire, so I'm guessing there was.
Yeah, there were. So the fire piece was actually just an annual inspection. Essentially, the fire marshal had come in for the annual inspection and had, I think it was a fire extinguisher and smoke detector deficiencies. They weren't complete. It wasn't like there were no burned units or anything like that. But we had been told that it was taken care of. Then we contacted the fire marshal. He's like, that's not so that ended up being something we had to deal with post closing, but it wasn't like, oh, we found out there were a bunch of burned units. That's not the case. As far as surprises during due diligence, the biggest thing, and I mean, this is like every property to me, I'm always shocked at what some people are willing to live in. And one of the things that was a surprise to us is there was a unit that had cracked plumbing in the slab underneath. And so turns out if they hadn't used the toilet or run the shower or anything recently, you couldn't really tell. But then if they were running water using an excessive amount of water, it would leak up and then be kind of in the living room. So that was a thing that was withheld from us, that information, and not something that it's under the slab. And we did have the lines that we could get to, we had them scoped. But for people that don't know, having the line scoped requires, if you don't have clean outs, which a lot of these older buildings don't, you've got to remove toilets, and the lines don't always make sense. So the plumbers might miss things if they're not specifically looking for them. So this was another thing that we found out after we took over, that I guess in hindsight, could we have done more due diligence and scoped, insisted on scoping every single unit? Sure, but it's something that we had to deal with after the fact. So that was probably the biggest surprise.
And we already talked a little bit about the surprises on the financial due diligence. Now, question here: what did you put the property? What did you guys get the property at, or what did you put it under contract for? Let's start with that number. And then whenever you started uncovering these surprises with vacancy and delinquency, provided you actually uncovered those during the due diligence period, did you retrade?
We did not retrade. So we got it under contract as $135 a unit. So it was $9,450,000 was the purchase price. We didn't retrade. Most of this stuff, unfortunately, was they misrepresented, I guess I'll put it that way, in terms of, so like this cracked drain line that we had to dig up a unit. I mean, it was after we took over, that tenant came to us and said, hey, I've been staying at a hotel for the last week or something like that because my plumbing was leaking again. And it was like, what are you talking about? So there were some things that really got I think, I will always look back and say, can we always do a better job? Sure, we can always do a better job. So are there things I would do differently in due diligence? Yes. Again, I think sometimes it comes down to the fact that if you're in a seller's market or a buyer's market, there can be more pushback, because we even went back for a pre-purchase or pre-close inspection 2 days before, and they pushed back on which units they wanted us to go in and things like that. So there were some questions that we could have walked away from the deal. I don't think we should have, even knowing what I know now. I think it's just something we had to work through.
Mm. All right, well, let's talk about the capital stack a little bit. So you have the general partners. You said you had partners on this deal, and then you also raised capital. Let's talk about, how did you structure the general partner side?
So we have, I don't know if this is standard for everybody, but basically you have, sort of an allocation for acquisitions, which I did. You have an allocation for underwriting, and then you have an allocation for capital raising and then asset management. And typically, like what we've done, and I think people do this differently, is it's essentially we almost divide it into thirds. So you have acquisition and underwriting as 1/3, you have the capital raising as 1/3, and you have the asset management as 1/3. And so we broke that up. In terms of dividing up the GP, the capital raising is the easiest part to sort of objectively divide, because you figure out how much am I going to raise, and you can literally do math to figure out how much each dollar is worth in that part of the GP. It's the other things that get a little bit more I guess subjective as to who did what, who's going to do what. I think it's a good thing for people to really, when you're working with partners, to really define that and say, hey, I'm going to do this, you're going to do this, this is how much we allocate, and have those discussions ahead of time. If you have a deal that you have to have a key principal on, you may have a portion of that GP allocated to them. So there's again, it's like another one of those, it depends. But that's typically how we approach it. It's a third for everything that leads up to raising capital, and then a third for the capital and a third for asset management.
All right, so let's talk about financing on the deal. So how much did you guys get in lending? What type of lending was it? Your rate? Let's talk about the terms.
Yeah, so we have bridge debt on this one. We have a floating rate debt, or floating rate loan, which turned out to be, fortunately, we did underwrite it for it going up, but it turned out to be a lot different than kind of how we saw it going. Obviously, one thing that I think is probably important to mention, and I didn't even really know the importance of this going into this particular deal, are the rate caps. I think it was something that used to be a bit of a formality, but by the time we got to closing, the rate cap was, I think we paid $190,000 for the rate cap. And this is relatively small, I guess, in terms of loans, right? It's not, I guess, outside the small balance loan, but in terms of loans, this isn't like a $50-60 million deal. People on those deals are paying in the millions for their rate caps, or have been over this last year. So yeah, we have a rate cap that has kept us from sort of, I guess, really losing our shirts on where the interest rates went. We hit the rate cap about a month and a half after we closed, because interest rates went up so fast. So it's actually kept us in a way protected by having that in place. So the lender required it. So it wasn't something that it was like, I can't say we had the foresight to say, oh, we definitely need to do this, but I certainly think it's something that I'll look at in the future. So bridge debt, floating rate. We have the primary loan, which was 75% loan to value, and we also have a CapEx budget which we can draw upon from there. So essentially, we presented them, here's our budget, this is what we think we're going to do. And as that goes through the underwriting process, they approve a certain amount for us to be able to draw off of as we perform the renovations that we had intended, and then that becomes a part of the loan as well.
And how long is your interest only period on this?
Our interest only is the entire portion of the loan. We have a 2-year loan with 3 1-year extensions. So in theory, we can have this loan for 5 years.
Okay. And then do you have to repay for the rate cap at each extension?
Potentially. Yeah, potentially. And that's something that I've seen, and we're sort of already gearing up for that possibly being something we have to do. They didn't say we do. It's going to depend on the interest rate environment for sure at that time. So the one thing that could come up, and again, we've started looking at this from a cash flow perspective, but some people are having to essentially set reserves aside for whatever that rate cap, like the expectation that they're going to have to pay again for a rate cap. So I've seen that be something that people are having to add on to like their budgets.
Yeah, like escrow for that.
Yeah, exactly. Yeah, the lenders want to know that when it comes time, you've got that sitting there, and it's not going to be this big surprise and panic that now we got to come up with however much that money is.
Mm-hmm. And I'm sure that impacts the bottom line and the cash flow in the deal.
It does. There's unfortunately a lot of and this deal for us is, we're not even a year in. We didn't have any intention to start distributions for the first 6 months anyway. We've pushed it back another quarter just because of what's going on with the interest rate world. And I think in some ways we just need to look at preservation of capital, not, kind of growth at this point. And then, our investors have a preferred return that will be accumulating for them.
Yeah, I did a boot camp earlier today with investors and showed them essentially modeling how to reach financial freedom or independence, whatever their financial milestone is in five years. And we were looking at the numbers, and the question came up was, okay, where is my distribution in this timeline? And I'm like, okay, well, hold on. First of all, the operator's first priority is to preserve the asset and not lose money.
Right.
So and it is a bit of a juggle right now for sure. So let's talk about your investor. You guys raised capital on this deal. How much did you guys raise, and what were the overall terms that you offered your investors?
Yeah, for this one, we have it was 3.3 million on the raise, and basically we have a 7% preferred return and a 70-30 split after that.
Okay, and any IR hurdles or anything like that?
No, we just once we reach the pref, then it's straight 70-30 split for the rest.
Okay, and then what were the fees that you guys took on the deal?
We had a 2% acquisition fee. In theory, we have a asset management fee on there. We actually haven't taken it on any of our deals at this point, just because of the challenge of the market. So it's, for me, it's very important to put the investors first. And I think I guess it depends on how it's written in your PPM. You have the right to take the asset management fee prior to making your preferred return, but I don't like that idea. I like the idea of making sure that they get their money first, and then if there's money left over for an asset management fee, then we'll do that. So and then I guess there's also it's written in as a 1% disposition fee as well.
Okay. All right, so you did allude to some surprises after takeover. Anything else that came up?
I think like I said, that plumbing issue was the big one. The main surprise, and I guess I need to stop being surprised by it, but is the speed at which evictions are happening. The number of people that are, and I don't want anyone to be homeless or anything like that, but at some point, we're all the landlords are running a business, and if people aren't paying to live there, but we're still expected to pay all the expenses and our debt service and all of that. It's not a it's kind of not sustainable at some level. Everybody writes in some level of economic vacancy in your underwriting, and you should be pretty conservative on those numbers, especially now. But in reality, at the end of the day, it doesn't make sense that we can't move forward with evictions, but also we still have to pay everything else. It's just kind of not, I'm not an economist. This is like what's going on in the entire country and other industries as well. But it's just one of those things that a lot of it doesn't make sense.
Mm-hmm. And is that just local to Atlanta, or do you feel this is a trend like nationally?
I think that it is. I focus pretty much exclusively as an operator in Atlanta, but I am invested passively in other deals, and like I'm in a deal that is outside of Charlotte, North Carolina. They just paused distributions for essentially all the same reasons that we are. Like there's some pretty big names in the industry that are running into the same problems. I don't think it's equal across the markets. I don't think it's equal even across asset classes, but like that deal I just alluded to that I'm a passive investor in is a B class, like pretty nice area. I know the area because my wife's from Charlotte. Like it's not like an area that you would expect to necessarily have these problems. So I suspect it's fairly universal, with probably some places where it's easier and some places where it's harder.
Well, thank you so much for your time and insights. I have a couple questions for you to wrap up. And you shared so many challenges, so we can always just kind of point back to what we've already covered. But what did you find easy on the deal that you thought was going to be more challenging, and what was challenging on the deal that you thought was going to be easier?
I think, ultimately the acquisition and closing process, which is what a lot of people kind of focus on in when they're starting, right? They're looking like, I got to find a deal. Once you have done that process, it gets easier pretty quickly, right? It gets easier. You start to build your team, you start to develop your processes. So the actual closing process becomes easier. I also think that the construction management, like your value add projects, again, once you've built a team and you're in a market you're familiar with, that stuff gets easier. It wasn't hard for us to make a pivot in terms of what our business plan and scope of work in these units were. It wasn't that hard to kind of get things executed. So like I said, we haven't had any trouble. It's been easier to lease than I thought. I guess that's another thing I talked about before. But and what's been harder, again, I would just go back to that, sort of delinquency. I just don't, it's hard to fathom like the numbers of people that are just not paying rent. And it's like, not just to us, like this is like, I spoke with a group the other day that's putting together a petition in Atlanta because essentially everybody's going through the same thing. And again, I don't know if it's this way in every single city. I still think Atlanta is a great market and has a lot to offer, and I intend to continue to invest there. I think the infrastructure just has to catch up to the current problem.
Well, Jason, thank you so much for spending your time with us here today and sharing your expertise and insights. If people want to find out more about you, how can they reach out to you?
The best way probably is just email me, jason@larkcapital.com. Also pretty active on social media, either Jason Balara on LinkedIn or at Lark Capital on Instagram.
Awesome. Well, Jason, again, thank you so much for your time here today. We look forward to having you back and to discuss future deals.
Thank you so much, Whitney. It was awesome.